Okay, welcome. Today we're talking about risk management when it comes to trading. And what is risk management, first of all? Risk management is a money management approach that you take into your trading to protect your money. And it is using a stop loss. What is a stop loss? A stop loss is a point in the market where you decide to sell your position and realize the loss. So in essence, cut your loss so that you can move on to the next trade. Believe it or not, this is one of the most important things that a trader has to learn in order to be able to survive. Because you see, the problem is that many people run out of funds. Many people come to trading with ideas of personal fulfillment, financial freedom, and all of those things. But the smart person realizes that if you don't have money, you can't actually trade anymore. And the problem with many new and even intermediate and even sometimes advanced traders when they lose their mojo is that they lose a lot of money on one trade and they blow out their account. So they don't have any more money to come and play. Now, a good approach for a beginner is to practice on a simulation account. And what that means is that you get to experience the movement of the market without actually risking any money. So it's like a game with play money. And you can top the account up with as much as you like. And because it's a simulation account, a demo account, if you lose that account, you can create another one. But when it comes to live trading, things are different. Now, coming back to the topic of risk management, why is it important? It is important because it will protect you from losing too much money too quickly to a point that you can't sustain. Let's take a basic example here, guys. Let's say you've got a £10,000 account and you start trading with that. And you take your first trade, you're excited. And you make a bit of money, let's say you make £100 or something like that, and you're very excited, you just made £100. And maybe you do that again and you have what's called beginner's luck. And you have 2 or 3 trades, and now your balance is looking like 10,400, 500 pounds after 3 trades. And now you go to the 4th trade. But this time, the market isn't behaving the way you want it to. You're, as an example, buyer. You're buying a commodity or asset class or whatever it is. And you want the price to rise, but it's not. It's dropping. Now, your floating loss is £10,200. Floating means you haven't realized the loss, the trade is still open. So it's fluctuating, right? And you say, no, I'm going to hold on. I'm sure it's going to come back. And it doesn't come back. A couple of hours later, you're back to break even. You're now at your £10,000 balance. And you say, oh, I can't believe it's £500 less than £500 of my profit has gone. And you can't bring yourself to close the trade. And you decide to close your computer, go for a walk, go meet some friends. And the next day you come back, hoping that the market is giving you the money back, except it hasn't. Now your balance is £8,000. And of course, at that point, the loss is too big for you to accept or realize, you hold on because you say, I can't accept this kind of a loss. So you hold on. A couple of days goes by. Now your balance has come down to £5,000. And you keep on holding, hoping and praying that the market is going to make you whole. 1 week goes by. Now your balance is £2,000. You've lost £8,000 from your balance. All the money you've been saving, working summer jobs, working part-time, doing things on the side. And now you're feeling that pain. And eventually what happens is the broker force liquidates your position because you don't have enough margin. You're out of the game and you've got £1,000 left or £500 left in your account, and you realize you've blown it. That is why risk management is important, guys. Okay? It's like going to the ocean with your small sailboat and trying to catch fish. The ocean is vast. The ocean is dominant. The ocean is the master. And you're just going there with a little sailboat trying to catch fish. That's what traders are doing. Just going there with small sailboats, or even a raft, trying to collect some fish and bring it back to shore. So the metaphorical connection or example there is the boat, the raft or whatever is your trading account. Once that's gone, the raft is blown into smithereens, the boat sinks, and that's the connection. That's the metaphoric expression there. So that is why risk management is important. And losing that kind of money is very painful. And many people, unfortunately, have gone through that experience of blowing accounts and feeling just disgusting and feeling a sheer amount of pain. So the market is always right. You cannot afford not to manage risk if you're going to trade or speculate in financial markets. There is just no room for error. And for those of you or some of you who have done this and you think, oh yeah, I've got away with it once or twice or 3 times or 4 times or 5 times, yeah. But all it needs is one time for you not to be lucky and your account is finished. Okay? And here's the cold hard truth. When you lose that kind of money, no one is going to come and give it back to you. No one is going to give it back to you. You won't get that kind of money from family, friends, anyone. Okay? It's a dangerous situation. You've got to manage risk. If you manage risk, you have a chance of staying alive. We're not even talking about being successful or profitable. Staying alive. If you manage risk, you have a chance to stay alive and live to fight another day. And if you don't manage risk, it is a recipe for absolute disaster. I hope you enjoyed that. And see you again next time. Cheers.